Disclaimer: the information provided on this channel is for general informational purposes only and should not be considered as professional financial advice. I am not a certified financial advisor, and the content on this channel should not be interpreted as a recommendation, solicitation, or endorsement of any financial products or services. I make every effort to ensure that the information presented in my videos is accurate and up to date. However, I cannot guarantee the completeness, reliability, or accuracy of the information provided. Viewers should do their own research and consult with a qualified financial professional before making any financial decisions. I am not liable for any losses or damages incurred as a result of the information presented on this channel. Viewers are solely responsible for their financial decisions and should exercise caution and prudence when implementing any financial strategies or investing in any financial products. The views and opinions expressed on this channel are solely those of the individuals involved and do not necessarily reflect the official policy or position of any other individual, organization, or company. This course is designed to provide a comprehensive understanding of mutual funds and equip you with the knowledge and skills to make informed investment decisions. Whether you are a beginner or an experienced investor, this course will take you on a journey through the world of mutual funds, covering key concepts, strategies, and best practices. By the end of the course, you will have the confidence and expertise to build a successful mutual fund portfolio. Understanding the basics. What are mutual funds and how do they work? Introduction: mutual funds are investment vehicles that pool money from multiple investors and invest it in a diversified portfolio of securities such as stocks, bonds, and other financial instruments. They are managed by professional fund managers who make investment decisions on behalf of the investors. Mutual funds offer individuals the opportunity to participate in the financial markets even with relatively small amounts of money. Key concepts. Mutual fund structure. A mutual fund is structured as a trust or a corporate entity. It is governed by a fund house or asset management company, AMC, that manages the fund's operations. The fund is overseen by a board of trustees or directors who ensure that the fund operates in the best interests of the investors. Net asset value, NAV. The net asset value represents the price of one unit of a mutual fund. It is calculated by dividing the total value of the fund's assets minus liabilities by the number of outstanding units. The NAV is published at the end of each trading day and reflects the fund's performance. Types of mutual funds. There are various types of mutual funds, each with its investment objective and strategy. Common types include equity funds, investing in stocks, debt funds, investing in bonds, balanced funds, mix of stocks and bonds, index funds, replicate a specific market index, and sector-specific funds, focused on particular sectors or industries. Diversification. Mutual funds offer diversification by investing in a wide range of securities. By spreading investments across different asset classes and companies, mutual funds reduce the risk associated with investing in a single security. Diversification helps to mitigate losses and potentially enhance returns. Fund manager. A mutual fund is managed by a professional fund manager or a team of managers. These experts conduct research, analyze market trends, and make investment decisions to achieve the fund's objectives. The fund manager's experience, expertise, and investment philosophy play a crucial role in the fund's performance. Investment process. Investors can buy units of mutual funds at the current NAV. The invested money is pooled with that of other investors and used to purchase a diversified portfolio of securities. The fund manager continuously monitors and manages the portfolio, buying and selling securities as per the investment strategy. Investors can redeem their units at the prevailing NAV, usually reflecting the fund's value at the end of the trading day. Benefits of mutual funds. Professional management. Mutual funds are managed by experienced professionals who have the knowledge and skills to make investment decisions based on research and analysis. Diversification. Mutual funds offer diversification by investing in a broad range of securities, reducing the risk associated with investing in individual stocks or bonds. Liquidity. Mutual funds provide liquidity to investors, allowing them to buy or sell units at the end of each trading day. Accessibility. Mutual funds are accessible to both individual and institutional investors, with various investment options catering to different financial goals and risk appetites. Conclusion. Mutual funds provide an accessible and professionally managed investment avenue for individuals to participate in the financial markets. By understanding the basics of mutual funds, investors can make informed decisions about investing in these funds and potentially achieve their financial goals. Types of mutual funds. Equity funds. Equity funds, also known as stock funds or equity mutual funds, primarily invest in stocks of publicly traded companies. These funds aim to provide long-term capital appreciation by participating in the growth potential of the stock market. Equity funds can be further categorized based on market capitalization, such as large cap, mid cap, and small cap funds. They can also be sector-specific, focusing on specific industries like technology, healthcare, or energy. Debt funds. Debt funds, also referred to as fixed income funds or bond funds, invest in fixed income securities such as government bonds, corporate bonds, treasury bills, and other debt instruments. The objective of debt funds is to generate income and preserve capital. These funds vary in risk levels, ranging from low-risk funds investing in high-quality bonds to higher-risk funds investing in lower-rated or longer-term bonds. Balanced funds. Balanced funds, also called hybrid funds, are a combination of equity and debt investments. They aim to provide both capital appreciation and income by maintaining a balanced portfolio. The fund manager allocates the fund's assets between equity and debt securities based on market conditions and the fund's investment objective. Balanced funds offer a balanced risk-reward profile, suitable for investors seeking both growth and stability. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500 or the Nifty 50. These funds invest in the same securities and in the same proportions as the underlying index. Index funds provide broad market exposure and typically have lower expense ratios compared to actively managed funds. They are designed for investors seeking low-cost passive investment strategies. Money market funds. Money market funds invest in short-term debt instruments with high credit quality and liquidity, such as treasury bills, commercial paper, and certificates of deposit. These funds aim to provide stability and preserve capital while generating a modest level of income. Money market funds are suitable for investors looking for a low-risk, highly liquid investment option. Sector funds. Sector funds focus on specific sectors or industries, such as technology, healthcare, real estate, or energy. These funds invest in companies within a particular sector, allowing investors to gain exposure to a specific industry's potential growth. Sector funds are considered more specialized and carry higher risk compared to diversified equity funds, as they are more susceptible to industry-specific factors. International or global funds. International or global funds invest in securities of companies listed outside the investor's home country. These funds provide exposure to international markets and can invest in a single country, a specific region, or globally diversified portfolios. Investing in international funds allows investors to benefit from global economic growth and diversify their investment portfolio geographically. Tax-saving funds. ELSS equity-linked savings schemes (ELSS) are equity funds that offer tax benefits under the Income Tax Act. Investments made in ELSS funds are eligible for tax deductions, making them a popular choice for individuals seeking tax savings along with the potential for long-term capital appreciation. ELSS funds have a lock-in period, typically 3 years, during which investors cannot redeem their investment. These are some of the common types of mutual funds available to investors. Each type has its unique characteristics, risk profiles, and investment objectives. It is essential for investors to consider their financial goals, risk tolerance, and investment time horizon when choosing mutual funds that align with their investment objectives. Advantages of investing in mutual funds. Diversification. Mutual funds provide instant diversification by pooling investors' money to invest in a wide range of securities. This diversification helps reduce the impact of volatility in individual stocks or bonds and spreads the risk across different assets, sectors, and geographies. Professional management. Mutual funds are managed by experienced fund managers who have in-depth knowledge of the financial markets. They conduct research, analyze investment opportunities, and make informed decisions on behalf of investors, saving them time and effort in managing their investments. Accessibility. Mutual funds are easily accessible to individual investors with different budgets. Investors can start with relatively small amounts and benefit from the expertise of professional fund managers who handle large investment portfolios. Liquidity. Mutual funds offer liquidity to investors, allowing them to buy or sell units at the end of each trading day. This provides flexibility for investors to enter or exit the fund as per their financial needs or changing market conditions. Variety of investment options. Mutual funds offer a wide range of investment options to cater to different investment objectives and risk appetites. Investors can choose from equity funds, debt funds, balanced funds, index funds, sector funds, international funds, and more, based on their preferences and financial goals. Transparency. Mutual funds provide regular updates to investors, including the net asset value, NAV, and portfolio holdings. This transparency enables investors to track the performance of their investments and make informed decisions. Disadvantages of investing in mutual funds. Fees and expenses. Mutual funds charge fees and expenses, including management fees, administrative expenses, and distribution charges. These costs can impact overall returns and reduce the amount of money available for investment. It is essential for investors to carefully evaluate the fees associated with a mutual fund before investing. Lack of control. When investing in mutual funds, investors delegate the investment decisions to the fund manager. This means they have limited control over the specific securities held in the portfolio. Investors need to trust the fund manager's abilities and investment approach. Potential for underperformance. While professional fund managers strive to generate attractive returns, there is a risk of underperformance. Not all mutual funds outperform their benchmarks consistently, and market conditions or investment strategy may affect fund performance. Investors should consider historical performance, fund objectives, and the track record of the fund manager when selecting mutual funds. Tax considerations. Mutual fund investments can have tax implications. Capital gains realized by the fund from buying and selling securities may be taxable for investors. Additionally, if the fund distributes dividends, investors may be liable to pay taxes on those distributions. It's crucial for investors to understand the tax implications and consider tax-efficient investment strategies. Market risk. Mutual funds are subject to market risks, including the potential for losses due to market fluctuations. Factors such as economic conditions, interest rates, and geopolitical events can impact the value of the fund's investments. It is important for investors to carefully evaluate the advantages and disadvantages of investing in mutual funds and consider their individual financial goals, risk tolerance, and investment preferences before making investment decisions. Introduction to key investment concepts, NAV, expense ratio, AUM, and more. When investing in mutual funds, it is important to understand key investment concepts that can help you make informed decisions and evaluate the performance and cost-effectiveness of the funds. Here are some essential concepts to familiarize yourself with. Net asset value. NAV net asset value represents the per unit price of a mutual fund. It is calculated by dividing the total value of the fund's assets minus its liabilities by the number of outstanding units. The NAV is typically calculated at the end of each trading day and is an important indicator of the fund's performance. Expense ratio. The expense ratio is the annual cost of managing a mutual fund, expressed as a percentage of the fund's average net assets. It includes various expenses, such as management fees, administrative costs, distribution charges, and other operating expenses. The expense ratio is deducted from the fund's assets and affects the fund's overall returns. It is important to compare expense ratios across funds to assess their cost effectiveness. Assets under management, AUM. Assets under management refers to the total value of investments held by a mutual fund. AUM is an indicator of the fund's size and popularity. It can influence the fund's liquidity, performance, and ability to achieve its investment objectives. Larger funds may have advantages in terms of diversification and access to investment opportunities, but smaller funds may offer more flexibility and potential for higher growth. Load and no-load funds. Some mutual funds charge a sales fee or commission, known as a load, when you buy or sell units of the fund. These are referred to as load funds. On the other hand, no-load funds do not charge a sales fee and allow investors to buy or sell units without incurring additional charges. It is important to consider the impact of loads on your investment returns and assess whether the benefits of load funds justify the associated costs. Risk measures. Various risk measures help assess the volatility and potential downside of a mutual fund. Common risk measures include standard deviation, beta, and alpha. Standard deviation measures the historical volatility of the fund's returns, while beta indicates the fund's sensitivity to market movements. Alpha represents the fund's risk-adjusted excess return compared to a benchmark index. Understanding these risk measures can help you assess the risk profile of a fund and align it with your risk tolerance. Investment objective and strategy. Each mutual fund has a stated investment objective and strategy. The objective describes the fund's intended goals, such as long-term growth, income generation, or capital preservation. The investment strategy outlines how the fund aims to achieve its objectives, including the types of securities it invests in, geographical focus, sector preferences, and asset allocation. Understanding the investment objective and strategy helps you align your investment goals with the fund's intended approach. These investment concepts provide a foundation for evaluating mutual funds and making informed investment decisions. By understanding NAV, expense ratio, AUM, risk measures, and the fund's investment objective and strategy, you can assess the fund's performance, cost efficiency, and suitability for your investment needs and goals. Exploring the structure of mutual funds, asset management companies, trustees, and custodians. Mutual funds operate within a structured framework involving key entities that play essential roles in the fund's operations and ensure the protection of investors' interests. Understanding the structure of mutual funds involves familiarizing oneself with asset management companies, trustees, and custodians. Let's explore these entities. Asset management companies, AMCs. Asset management companies, also known as fund houses or investment management companies, are responsible for managing mutual funds. AMCs hire experienced fund managers and investment professionals who make investment decisions on behalf of the fund's investors. These professionals conduct research, analyze market trends, and determine the fund's investment strategy based on its stated objectives. The AMC oversees the fund's day-to-day operations, including portfolio management, investor services, and compliance with regulatory requirements. Trustees. Trustees are an integral part of the mutual fund structure and act in a fiduciary capacity to protect the interests of the fund's investors. Trustees are appointed by the asset management company and have a legal obligation to act in the best interests of the investors. They oversee the activities of the AMC and ensure compliance with the regulations governing mutual funds. Trustees are responsible for safeguarding the assets of the fund, ensuring that the fund's investments align with its stated objectives, and monitoring the performance of the AMC. Custodians. Custodians are financial institutions that hold and safeguard the mutual fund's assets. They are appointed by the trustees to provide custody services for the fund's securities, such as stocks, bonds, and other financial instruments. Custodians ensure the safekeeping of the fund's assets, maintain accurate records, and facilitate settlement of transactions. They play a vital role in protecting the fund's assets from loss, theft, or unauthorized use. Custodians also assist in fund accounting, valuation of securities, and ensuring compliance with regulatory requirements. The relationship between these entities is crucial for the smooth functioning and integrity of mutual funds. The AMC manages the fund's investments, the trustees safeguard investors' interests, and the custodians ensure the safekeeping of the fund's assets. The separation of these roles helps provide checks and balances, ensuring transparency, accountability, and adherence to regulatory guidelines. It is important to note that while the AMC, trustees, and custodians have distinct roles, they often collaborate and work closely to ensure the efficient and effective management of mutual funds. This collaborative effort helps safeguard investor interests, maintain the integrity of the fund, and provide transparency and accountability in the fund's operations. By understanding the structure of mutual funds and the roles played by asset management companies, trustees, and custodians, investors can gain confidence in the system and have a clearer understanding of how their investments are managed and protected within the mutual fund framework. Regulatory Framework Overview of SEBI Regulations and Guidelines. In India, the Securities and Exchange Board of India, SEBI, is the primary regulatory body responsible for overseeing and regulating the securities market, including mutual funds. SEBI plays a crucial role in ensuring investor protection, maintaining market integrity, and promoting transparency and fair practices. Here is an overview of the SEBI regulations and guidelines pertaining to mutual funds. SEBI, Mutual Funds, Regulations, 1996. The SEBI, Mutual Funds, Regulations, 1996, form the foundation of the regulatory framework for mutual funds in India. These regulations govern the establishment, registration, and operation of mutual funds. They cover various aspects, including the role of asset management companies, AMCs, the functions of trustees and custodians, investor rights, disclosure requirements, investment restrictions, and code of conduct for mutual funds. Registration and compliance. SEBI regulates the registration and compliance requirements for mutual funds. It sets the eligibility criteria and guidelines for AMCs, trustees, and custodians to obtain and maintain registration. Mutual funds are required to comply with ongoing regulatory requirements, including reporting, disclosure of information, and investor communication. Investor protection. SEBI focuses on ensuring investor protection and safeguards the interests of mutual fund investors. It mandates full disclosure of material information related to the fund, its investments, expenses, risk factors, and performance. SEBI also mandates clear and concise communication to investors, including periodic reporting, fund fact sheets, and simplified documentation such as scheme information documents and offer documents. Investment norms and portfolio restrictions. SEBI lays down investment norms and portfolio restrictions for mutual funds to maintain prudential investment practices. These norms govern areas such as asset allocation, concentration limits, exposure to specific sectors or industries, investment in derivatives, and borrowing and lending restrictions. The objective is to ensure that mutual funds adhere to prudent investment practices and manage risk effectively. Mutual fund expenses. SEBI regulates the expenses charged by mutual funds and aims to ensure that they are reasonable and in the interest of investors. Guidelines are in place to monitor and regulate various expenses, including management fees, administrative costs, marketing and distribution expenses, and fund operating expenses. SEBI mandates that mutual funds disclose the expense ratio, which represents the annual cost of managing the fund as a percentage of the fund's average net assets. Investor grievance redressal. SEBI has established a robust mechanism for investor grievance redressal. It requires mutual funds to have a dedicated investor grievance cell to address investor complaints and grievances promptly. SEBI monitors the grievance redressal mechanism and ensures that investors have access to an efficient and transparent process for resolving their grievances. SEBI's regulations and guidelines are periodically updated and refined to keep pace with the evolving market dynamics and investor needs. The regulatory framework established by SEBI provides a strong foundation for the mutual fund industry in India, promoting transparency, investor protection, and fair practices. Investors in mutual funds can gain confidence from the regulatory oversight provided by SEBI, knowing that their interests are protected and the mutual fund industry operates within a well-defined framework of regulations and guidelines. Understanding the role of a fund manager and the fund management team. In the world of mutual funds, the role of a fund manager and the fund management team is crucial. They are responsible for making investment decisions, managing the fund's portfolio, and striving to achieve the fund's investment objectives. Let's explore their roles and responsibilities in more detail. Fund manager. A fund manager is the key individual responsible for overseeing the management of a mutual fund. Their primary role is to make investment decisions on behalf of the fund's investors. Here are some key aspects of a fund manager's role. Investment strategy. The fund manager formulates the fund's investment strategy and determines the asset allocation, which includes deciding how much to invest in different asset classes like stocks, bonds, and cash equivalents. They analyze market trends, economic indicators, and company-specific information to identify investment opportunities aligned with the fund's objectives. Security selection. The fund manager selects specific securities, such as stocks, bonds, or other financial instruments, for the fund's portfolio. They conduct thorough research, fundamental analysis, and valuation techniques to identify securities that have the potential for growth or income generation, depending on the fund's investment objective. Portfolio management. The fund manager actively manages the fund's portfolio, making buy or sell decisions based on market conditions and the investment strategy. They monitor the performance of individual securities, track market trends, and adjust the portfolio as required to optimize returns or manage risk. Risk management. Fund managers assess and manage the risks associated with the fund's investments. They employ risk management techniques, such as diversification, hedging, or asset allocation strategies, to mitigate potential downside risks and protect the fund's value. Performance evaluation. Fund managers closely monitor the fund's performance against relevant benchmarks and peer groups. They analyze the fund's returns, risk metrics, and other performance indicators to evaluate its success in achieving its investment objectives and make necessary adjustments to improve performance. Fund management team. In larger mutual fund organizations, the fund manager is supported by a team of professionals who collectively form the fund management team. The team works together to ensure effective portfolio management and meet the fund's objectives. The fund management team typically includes research analysts. Research analysts support the fund manager by conducting in-depth research on specific industries, sectors, or companies. They analyze financial statements, market trends, and other relevant data to identify investment opportunities and provide recommendations to the fund manager. Traders. Traders execute the buy and sell orders as directed by the fund manager. They work closely with the fund manager to ensure timely and efficient execution of trades while adhering to regulatory requirements and market best practices. Risk management experts. Risk management experts within the team focus on identifying and mitigating risks associated with the fund's investments. They assess the fund's exposure to various market risks and help implement risk management strategies. Operations and compliance professionals. These team members handle the administrative and operational aspects of the fund, including trade settlement, compliance with regulatory guidelines, reporting, and investor services. They ensure that the fund's operations are conducted smoothly and in adherence to relevant regulations. The fund management team collaborates closely to execute the investment strategy, manage the fund's portfolio, and navigate the dynamic financial markets. Their combined expertise, knowledge, and experience contribute to the fund's overall performance and the achievement of its investment objectives. Investors can gain confidence in a mutual fund when they have clarity about the role of the fund manager and the composition of the fund management team. Evaluating the track record, investment philosophy, and expertise of the team is an important aspect of selecting mutual funds that align with individual investment goals and risk tolerance. Legal and compliance aspects: fund prospectus, offer document, and scheme information document. When investing in mutual funds, it is essential to be aware of the legal and compliance aspects that govern these investment vehicles. Mutual funds are required to provide investors with key information through documents such as the fund prospectus, offer document, and scheme information document. Let's explore these documents and their significance. Fund prospectus. The fund prospectus is a comprehensive legal document provided by the mutual fund to potential investors. It contains detailed information about the fund, its investment objective, investment strategies, risks involved, fees and expenses, fund manager's profile, and other pertinent details. The prospectus is prepared in compliance with regulatory requirements and provides investors with crucial information to make informed investment decisions. Purpose: the fund prospectus serves as an important disclosure document that outlines the terms and conditions of the mutual fund. It enables investors to understand the fund's investment approach, risks, costs, and other relevant information before investing. Contents: the prospectus includes information on the fund's investment objective, asset allocation, investment strategies, past performance, where applicable, risk factors, expense ratio, benchmark, distribution policy, taxation, and details of the fund house and trustees. It also highlights any unique features or restrictions associated with the fund. Offer document. The offer document is a legal document provided to potential investors when a mutual fund's new scheme or plan is launched. It contains specific details related to the new scheme, including investment objective, features, terms and conditions, risk factors, fees, and other relevant information. The offer document is prepared in accordance with regulatory guidelines and ensures transparency in the offering of new mutual fund schemes. Purpose: the offer document serves as a key source of information for investors who are considering investing in a newly launched mutual fund scheme. It provides essential details about the scheme's investment strategy, risks, and other attributes, helping investors assess its suitability for their investment goals. Contents: the offer document includes information about the scheme's investment objective, asset allocation, investment strategy, risk factors, fees and expenses, benchmark, and the process for subscribing to the scheme. It also outlines the rights and obligations of the investors and provides contact details for any further queries or clarifications. Scheme Information Document, SID. The Scheme Information Document, SID, is a document specific to each mutual fund scheme and provides detailed information about that particular scheme. It is prepared in compliance with regulatory requirements and provides investors with a comprehensive understanding of the scheme's features, investment strategy, risks, and other relevant details. Purpose: the SID is designed to provide investors with detailed information about a specific mutual fund scheme. It helps investors evaluate the scheme's investment objective, asset allocation, risk factors, historical performance, expense ratio, and other critical aspects before making investment decisions. Contents: the SID includes detailed information about the scheme's investment objective, asset allocation pattern, investment strategy, risks associated with the scheme, historical performance, expense ratio, benchmark, minimum investment amount, exit load, taxation implications, and details of the fund manager and other key personnel. It also provides information on the process for investing, redeeming, and switching units. It is important for investors to carefully review the fund prospectus, offer document, and scheme information document before investing in a mutual fund. These legal documents provide valuable information about the fund's objectives, strategies, risks, costs, and other factors that are essential in making informed investment decisions. By understanding the contents of these documents, investors can assess the suitability of a mutual fund and align it with their investment goals and risk tolerance. Key factors to consider when selecting a mutual fund. Selecting the right mutual fund is crucial for achieving your investment goals and maximizing returns while managing risk. With a vast array of mutual funds available, it is important to consider several key factors to make an informed investment decision. Here are some factors to evaluate when selecting a mutual fund. Investment objective. Understand your own investment objective. Determine whether you are seeking capital appreciation, income generation, or a balance of both. Choose a mutual fund that aligns with your investment goals and risk tolerance. Different funds have different objectives, such as growth funds, income funds, value funds, or sector-specific funds. Performance track record. Review the fund's historical performance over different time periods, comparing it to relevant benchmarks and peer groups. Assess the consistency of returns and consider both short-term and long-term performance. However, past performance is not a guarantee of future results, so it should be evaluated in conjunction with other factors. Fund manager expertise. Evaluate the experience and track record of the fund manager and the fund management team. Look for their investment philosophy, style, and approach. A skilled and experienced manager with a proven track record can significantly contribute to a fund's performance and adapt to changing market conditions. Risk and volatility. Assess the risk level associated with the mutual fund. Consider measures such as standard deviation and beta to gauge the volatility of the fund's returns compared to its benchmark. Determine your risk tolerance and choose a fund that aligns with your comfort level. Fees and expenses. Understand the fund's expense ratio, which represents the annual cost of managing the fund. Lower expense ratios can contribute to higher returns. Compare fees across similar funds and consider the impact of expenses on long-term performance. Diversification. Evaluate the fund's diversification strategy. A well-diversified fund reduces the concentration risk associated with individual securities or sectors. Look for funds that invest across different asset classes, industries, and regions to mitigate risk and potentially enhance returns. Fund size and liquidity. Consider the fund's size and liquidity. While larger funds may offer advantages in terms of resources and diversification, smaller funds may be more flexible and potentially have higher growth prospects. Additionally, assess the fund's liquidity and ease of buying or selling units. Fund house reputation and stability. Research the reputation and stability of the fund house or asset management company, AMC. Look for established AMCs with a strong track record of managing funds and serving investors' interests. Assess their financial strength, corporate governance practices, and adherence to regulatory guidelines. Fund disclosure and transparency. Evaluate the transparency of the fund. Look for clear and detailed disclosure of portfolio holdings, investment strategies, risks, and expenses. Transparent funds provide investors with the necessary information to make informed decisions and track their investments. Investor services and support. Consider the quality of investor services and support provided by the fund house. Look for ease of access to account information, customer support, online tools, and educational resources that can help you monitor and manage your investments effectively. It is crucial to conduct thorough research, review relevant documents, and seek professional advice if needed when selecting a mutual fund. Each investor's financial goals, risk appetite, and investment horizon are unique, so it is important to choose a mutual fund that suits your specific requirements and aligns with your investment strategy. Analyzing fund performance, NAV, returns, risk measures, and benchmark comparison. When evaluating mutual fund performance, several key factors need to be considered. By analyzing these factors, investors can gain insights into a fund's historical performance, risk profile, and its ability to meet their investment objectives. Here are some key elements to assess when analyzing fund performance. Net asset value, NAV. The net asset value represents the price per unit of a mutual fund. Monitoring the NAV over time helps track the fund's performance. A rising NAV indicates positive returns, while a declining NAV suggests negative returns. However, NAV alone is not sufficient to evaluate a fund's performance comprehensively, as it doesn't consider the effect of expenses or compare the fund to its peers or benchmarks. Returns are a fundamental measure of a fund's performance. Investors should assess returns over different time periods, such as 1 year, 3 years, 5 years, and since inception. It is important to compare a fund's returns with its benchmark index and similar funds within the same category. This enables investors to gauge the fund's ability to generate competitive returns. Absolute returns indicate the actual percentage increase or decrease in a fund's NAV over a specific period. It helps measure the fund's standalone performance without considering external factors. Relative returns compare a fund's performance to a benchmark index or peer group. It provides insights into how the fund has performed relative to its intended market or investment category. A positive relative return indicates that the fund outperformed its benchmark or peers, while a negative relative return suggests underperformance. Risk measures. Assessing risk measures helps understand a fund's volatility and potential downside. Here are some commonly used risk measures. Standard deviation. Standard deviation measures the historical volatility of a fund's returns. A higher standard deviation indicates greater volatility and potential for larger fluctuations in returns. Beta measures the sensitivity of a fund's returns to movements in the overall market. A beta of 1 suggests that the fund's returns move in line with the market, while a beta greater than 1 indicates higher volatility than the market, and a beta less than 1 suggests lower volatility. Sharpe ratio. The Sharpe ratio assesses a fund's risk-adjusted returns. It takes into account both the fund's returns and the level of risk it assumes. A higher Sharpe ratio indicates better risk-adjusted returns. Sortino ratio. The Sortino ratio is similar to the Sharpe ratio but focuses only on downside risk. It measures the excess return of a fund relative to its downside volatility, providing a more focused assessment of risk-adjusted performance. Benchmark comparison. Comparing a fund's performance to a relevant benchmark is essential to understand its relative performance. The benchmark should be appropriate for the fund's investment style or category. Assess how the fund has performed relative to its benchmark over various time periods and evaluate whether it has consistently outperformed, matched, or underperformed the benchmark. Excess returns. Excess returns indicate the difference between a fund's returns and its benchmark returns. Positive excess returns suggest that the fund has outperformed its benchmark, while negative excess returns indicate underperformance. Consistency. Consider the fund's ability to consistently meet or exceed its benchmark over multiple periods. Consistency in outperforming the benchmark can demonstrate the fund manager's skill in generating above-average returns. It is important to note that past performance is not a guarantee of future results. Therefore, while historical performance and risk measures provide valuable insights, they should be considered alongside other factors such as investment objective, fund manager's expertise, and market conditions when evaluating a mutual fund's potential. By analyzing a fund's NAV, returns, risk measures, and benchmark comparison, investors can gain a comprehensive understanding of a fund's historical performance, risk profile, and its ability to generate competitive returns. This analysis serves as a valuable tool in making informed investment decisions aligned with individual financial goals and risk tolerance. Evaluating fund managers, track record, investment style, and fund objectives. When selecting a mutual fund, evaluating the fund manager is crucial as they play a pivotal role in shaping the fund's performance and investment strategy. Here are key factors to consider when evaluating fund managers. Track record. Assessing a fund manager's track record helps evaluate their historical performance and ability to generate consistent returns. Consider the fund manager's performance across different market cycles and time horizons. Look for managers who have demonstrated consistent success in achieving their fund's investment objectives. However, keep in mind that past performance is not a guarantee of future results. Consistency. Look for fund managers who have consistently delivered strong performance, considering both relative and absolute returns. Consistency in outperforming benchmarks or peers can indicate skill and expertise in navigating various market conditions. Longevity. Evaluate the fund manager's tenure and experience. A long and successful track record suggests the manager has demonstrated the ability to adapt to changing market dynamics and deliver consistent performance over an extended period. Asset size and performance. Consider the fund manager's ability to manage larger asset sizes without compromising performance. Assess whether the manager has been able to maintain performance and investment style as the fund's assets under management (AUM) have grown. Investment style and philosophy. Understanding the fund manager's investment style and philosophy is crucial in determining if it aligns with your investment objectives and risk tolerance. Different fund managers employ various investment styles, such as value investing, growth investing, or a blend of both. Consider the following. Investment approach. Evaluate whether the manager follows a disciplined and consistent investment approach. For example, some managers may focus on fundamental analysis, while others may incorporate quantitative models or technical analysis. Risk management. Assess the manager's approach to risk management. Look for managers who demonstrate a disciplined approach to managing risk, including diversification, position sizing, and downside protection strategies. Consistency with fund objectives. Ensure that the fund manager's investment style aligns with the fund's stated investment objectives. For example, if the fund aims for long-term capital appreciation, a manager with a track record of generating steady growth may be suitable. Fund objectives and alignment. Evaluate how well the fund manager's investment style and track record align with the fund's stated objectives. Consider the following. Risk-return profile. Assess if the fund manager's historical performance aligns with the fund's risk-return profile. A manager who consistently delivers returns within the expected range of the fund's objectives demonstrates alignment. Investment horizon. Consider the fund manager's ability to maintain their investment style and generate returns over the fund's stated investment horizon. This is particularly important for funds with specific timeframes, such as retirement funds or target date funds. Communication and transparency. Evaluate the manager's communication style and transparency in providing updates, insights, and explanations for investment decisions. A manager who demonstrates transparency and clear communication can enhance investor trust. It is important to note that while a skilled fund manager is crucial, no individual can consistently outperform the market in the long term. Evaluating fund managers is just one aspect of the overall due diligence process when selecting a mutual fund. Other factors such as fees, risk measures, and fund characteristics should also be considered. By considering a fund manager's track record, investment style, and alignment with fund objectives, investors can gain insights into their ability to deliver consistent returns, manage risk, and align with their investment preferences. This evaluation helps investors make informed decisions when selecting mutual funds that align with their financial goals and risk appetite. Utilizing resources for researching mutual funds, websites, financial portals, and ratings agencies. When researching mutual funds, it is important to leverage various resources to gather comprehensive and reliable information. There are several online platforms, financial portals, and ratings agencies that provide valuable insights and analysis on mutual funds. Here are some key resources to consider. Websites of fund houses. Start by visiting the official websites of mutual fund houses or asset management companies, AMCs. Fund houses provide information about their funds, investment philosophy, fund manager profiles, fund performance, expense ratios, and other relevant details. These websites serve as primary sources of information directly from the fund managers themselves. Financial portals. Financial portals offer a wealth of information and tools for researching mutual funds. They provide access to comprehensive databases, comparison tools, and analytical resources. Here are a few well-known financial portals. Morningstar. Morningstar provides a wide range of information on mutual funds, including fund performance, historical returns, expense ratios, portfolio holdings, risk measures, and analyst ratings. Morningstar's fund rating system helps investors evaluate a fund's past performance relative to its peers. Yahoo Finance. Yahoo Finance offers a variety of resources for mutual fund research. It provides fund profiles, historical performance data, expense ratios, portfolio details, risk measures, and news related to mutual funds. Yahoo Finance also offers a platform for comparing funds and tracking their performance. Bloomberg. Bloomberg provides comprehensive financial information, including mutual fund data. It offers a wide range of tools and analytics for researching and comparing mutual funds. Bloomberg's platform provides detailed fund profiles, historical performance data, benchmark comparisons, and risk metrics. Google Finance. Google Finance provides a user-friendly interface for researching mutual funds. It offers access to fund profiles, performance data, expense ratios, and related news. The platform allows users to compare funds and create watch lists to track their chosen funds. Ratings agencies. Ratings agencies evaluate mutual funds based on various criteria, providing independent assessments of a fund's quality, risk, and performance. These agencies assign ratings or ranks to mutual funds to help investors make informed decisions. Some notable ratings agencies include Standard & Poor's. S&P provides fund ratings that assess a fund's risk-adjusted performance compared to its peers. The ratings range from 1 to 5 stars, with 5 stars representing the highest rating. Morningstar. Morningstar assigns ratings, known as star ratings, to mutual funds based on historical risk-adjusted performance. These ratings are a reflection of a fund's past performance compared to similar funds within its category. Lipper. Lipper, a subsidiary of Refinitiv, offers rankings and ratings for mutual funds based on performance metrics and risk-adjusted returns. These rankings provide insights into a fund's performance relative to its peers. It is important to consider multiple sources of information and use them in conjunction with each other to gain a comprehensive view of a mutual fund. By leveraging websites, financial portals, and ratings agencies, investors can access performance data, expense ratios, risk measures, portfolio holdings, and expert analysis. This research allows investors to make informed decisions based on a holistic understanding of mutual funds and align their investments with their financial goals and risk tolerance. Introduction to asset allocation, determining the right mix of equity, debt, and other asset classes. Asset allocation is a crucial concept in investment management that involves determining the appropriate mix of asset classes, such as equity, debt, and other categories, within a portfolio. The goal of asset allocation is to create a diversified portfolio that aligns with an investor's financial goals, risk tolerance, and time horizon. Here's an introduction to asset allocation and its key considerations. Understanding asset classes. Asset classes are broad categories of investments with similar characteristics and risk-return profiles. The main asset classes include equity. Equity represents ownership in a company. Investing in equities provides the potential for capital appreciation and income through dividends. Equity investments carry a higher level of risk but historically have shown the potential for higher long-term returns. Debt/fixed income. Debt instruments, such as bonds and fixed income securities, represent loans made to entities like governments, corporations, or municipalities. Debt investments offer regular interest payments and the return of principal at maturity. They are generally considered lower-risk investments compared to equities. Cash and cash equivalents. Cash and cash equivalents include instruments with high liquidity, such as money market funds and short-term treasury bills. These assets offer stability and act as a source of liquidity in a portfolio. Alternative investments. Alternative investments encompass a wide range of assets beyond traditional equities and debt. Examples include real estate, commodities, hedge funds, private equity, and infrastructure. These assets have different risk-return characteristics and can add diversification to a portfolio. Importance of asset allocation. Asset allocation is crucial because it can significantly impact a portfolio's risk and return profile. By diversifying across asset classes, investors aim to reduce risk and increase the potential for long-term growth. Proper asset allocation takes into account factors such as an investor's risk tolerance, investment goals, time horizon, and market conditions. Determining the right mix. Determining the right asset allocation mix depends on individual circumstances and financial goals. Here are key considerations. Risk tolerance. Assess your risk tolerance, which reflects your ability to tolerate fluctuations in the value of your investments. Higher risk asset classes like equities have the potential for higher returns but also greater volatility. Conservative investors may prefer a higher allocation to debt instruments for stability, while aggressive investors may opt for a higher equity allocation. Investment goals and time horizon. Consider your investment goals, such as wealth accumulation, income generation, or capital preservation. Also, determine your time horizon, the length of time you plan to invest. Longer time horizons may allow for more exposure to higher risk assets, as there is more time to potentially recover from short-term market fluctuations. Diversification. Diversify across asset classes to spread risk. The correlation between different asset classes affects portfolio diversification. Assets that have a low correlation to each other may help reduce the overall volatility of a portfolio. Diversification can be achieved by investing in multiple asset classes, geographies, sectors, or investment styles. Regular rebalancing. Regularly review and rebalance your portfolio to maintain your desired asset allocation. Over time, the performance of different asset classes may deviate, causing your portfolio to become imbalanced. Rebalancing involves buying or selling assets to restore the desired allocation. Seeking professional advice. Asset allocation decisions can be complex, and investors may benefit from seeking advice from financial professionals or investment advisors. They can provide personalized guidance based on individual circumstances, risk tolerance, and investment objectives. It's important to note that asset allocation is not a one-time decision. It should be periodically reviewed and adjusted as circumstances change. Market conditions, personal circumstances, and investment goals may evolve over time, requiring adjustments to the asset allocation mix. By understanding asset classes, assessing risk tolerance, setting investment goals, and diversifying across different asset classes, investors can create a well-balanced portfolio that aligns with their financial objectives and risk tolerance. Regular monitoring and adjustment of asset allocation can help investors stay on track towards their long-term financial goals. Diversification strategies and risk management techniques. Diversification is a fundamental principle in investment management that aims to reduce risk by spreading investments across different assets, sectors, regions, or investment styles. By diversifying a portfolio, investors can potentially minimize the impact of individual investment losses and improve the overall risk-return profile. Here are some common diversification strategies and risk management techniques. Asset class diversification. Diversifying across different asset classes is a primary method of risk management. It involves allocating investments across equities, bonds, cash equivalents, and alternative investments. Different asset classes have varying risk-return characteristics, and their performance may vary under different market conditions. By diversifying across asset classes, investors can potentially benefit from the performance of different market segments and reduce exposure to any single asset class. Geographic diversification. Geographic diversification involves spreading investments across different regions and countries. Different economies and markets can perform differently at various times due to factors such as economic growth, political stability, and currency fluctuations. By investing in a range of global markets, investors can potentially reduce the impact of regional economic downturns and benefit from opportunities in different regions. Sector diversification. Sector diversification involves investing in companies across various industries or sectors. Different sectors can perform differently depending on economic conditions, industry trends, or regulatory changes. By diversifying across sectors, investors can reduce exposure to the risks associated with any single sector and potentially benefit from the performance of different sectors at different times. Company size diversification. Company size diversification, also known as market capitalization diversification, involves investing in companies of different sizes. Stocks of large cap, mid cap, and small cap companies have distinct risk-return profiles. Large cap companies are typically more stable, while small cap companies may offer higher growth potential but with increased volatility. By diversifying across different company sizes, investors can potentially balance risk and return within their portfolio. Risk management techniques. In addition to diversification, risk management techniques can further mitigate potential risks within a portfolio. Here are some commonly used risk management techniques. Stop-loss orders. Stop-loss orders set predetermined price levels at which securities are automatically sold, helping to limit potential losses in case of a significant decline in prices. Hedging. Hedging involves using financial instruments such as options, futures, or derivatives to offset potential losses in a portfolio. It aims to protect against adverse market movements by taking offsetting positions. Dollar cost averaging. Dollar cost averaging is a strategy where investors consistently invest a fixed amount of money into a particular investment at regular intervals, regardless of market conditions. This strategy can help mitigate the impact of short-term market fluctuations and potentially lower the average cost per unit. Asset allocation rebalancing. Regularly rebalancing a portfolio ensures that the asset allocation remains aligned with the investor's desired risk profile. Rebalancing involves selling or buying assets to maintain the target asset allocation, which helps manage risk and optimize returns. Risk assessment and monitoring. Continuously assess and monitor the risk profile of investments. Regularly review the portfolio's exposure to various risks, such as market risk, credit risk, and liquidity risk. This allows for proactive risk management and adjustment of investments as needed. It's important to note that diversification and risk management techniques cannot eliminate the risk of investment losses entirely. Market conditions, unforeseen events, and other factors can still impact the performance of investments. Therefore, it's recommended to diversify wisely and consult with financial professionals or investment advisors to tailor diversification and risk management strategies to individual goals and risk tolerance. By implementing diversification strategies and employing risk management techniques, investors can potentially reduce risk, enhance portfolio stability, and manage downside risks more effectively. These strategies aim to strike a balance between risk and return, aligning investment portfolios with individual financial goals and risk tolerances. Constructing a mutual fund portfolio based on investment goals and risk appetite. Constructing a mutual fund portfolio involves selecting a combination of funds that align with your investment goals and risk appetite. A well-structured portfolio considers factors such as your financial objectives, time horizon, risk tolerance, and diversification needs. Here are steps to help you construct a mutual fund portfolio. Determine investment goals. Start by clarifying your investment goals. Identify whether you aim for long-term capital appreciation, regular income, or a combination of both. Your investment goals will guide the selection of mutual funds that best align with your objectives. Assess risk tolerance. Understand your risk tolerance, which reflects your ability to handle fluctuations in the value of your investments. Assess your comfort level with market volatility, potential losses, and the time you can afford to stay invested. Conservative investors may prioritize capital preservation and prefer lower-risk funds, while aggressive investors may be willing to accept higher levels of risk for the potential of higher returns. Asset allocation. Determine the appropriate asset allocation based on your investment goals and risk tolerance. Asset allocation involves determining the percentage of your portfolio allocated to different asset classes, such as equities, bonds, and cash equivalents. A common approach is to allocate more to equities for long-term growth potential and to allocate more to fixed income or cash equivalents for stability and income generation. Consider diversifying across different sectors, regions, and investment styles within each asset class. Fund selection. Choose mutual funds that align with your investment goals, risk tolerance, and asset allocation strategy. Consider the following factors when selecting funds. Investment objective. Review the fund's investment objective to ensure it matches your goals. Look for funds that explicitly state their objective, such as growth, income, or a specific investment style. Performance. Assess the fund's historical performance relative to its benchmark and peer group over different time periods. Consider consistency, risk-adjusted returns, and long-term track record. Fund manager. Evaluate the fund manager's experience, expertise, and investment philosophy. Review the manager's performance across different market cycles and their ability to navigate changing market conditions. Expense ratio. Compare expense ratios across funds to ensure they are reasonable and in line with industry standards. Lower expense ratios can contribute to higher net returns over the long term. Risk measures. Assess risk measures such as standard deviation, beta, and Sharpe ratio to evaluate the fund's volatility and risk-adjusted performance. Fund holdings and strategy. Review the fund's holdings, sector allocations, and strategy. Ensure they align with your asset allocation and diversification goals. Fund size and liquidity. Consider the fund's size and liquidity. Larger funds may offer advantages in terms of resources and stability, while smaller funds may provide more flexibility. Liquidity is important for ease of buying or selling fund units. Portfolio monitoring and rebalancing. Regularly monitor your portfolio's performance and review it periodically to ensure it remains aligned with your investment goals and risk tolerance. Rebalance the portfolio if needed by adjusting the allocation of funds. Rebalancing involves selling or buying funds to restore the desired asset allocation. This ensures your portfolio remains on track and maintains its desired risk-return characteristics. Seek professional advice. Consider seeking guidance from financial professionals or investment advisors, particularly if you are unsure about constructing and managing your mutual fund portfolio. They can provide personalized advice based on your individual circumstances, investment goals, and risk tolerance. Remember that constructing a mutual fund portfolio is a dynamic process that should be reviewed and adjusted as your goals, risk tolerance, and market conditions change. Regular monitoring and periodic adjustments help ensure your portfolio remains aligned with your investment objectives. By considering investment goals, risk tolerance, asset allocation, fund selection, and portfolio monitoring, you can construct a well-diversified mutual fund portfolio that meets your financial goals, aligns with your risk appetite, and provides a balanced approach to achieving long-term success. Systematic investment plans, SIPs, and systematic transfer plans, STPs. Systematic investment plans, SIPs, and systematic transfer plans, STPs, are investment strategies offered by mutual funds that allow investors to invest and manage their funds in a disciplined and systematic manner. These plans provide flexibility, convenience, and potential benefits to investors. Let's explore SIPs and STPs in more detail. Systematic Investment Plans. SIPs. A systematic investment plan, SIP, is an investment strategy that enables investors to invest a fixed amount regularly in a mutual fund at predetermined intervals. Here's how SIPs work. Regular investments. With SIPs, investors can make periodic investments, such as monthly or quarterly, rather than investing a lump sum. This approach encourages regular savings and helps in building wealth over time. Rupee cost averaging. SIPs implement the concept of rupee cost averaging. Since the investment amount remains constant, investors buy more units when the prices are lower and fewer units when prices are higher. This strategy helps reduce the impact of short-term market volatility and potentially provides a favorable average cost per unit over the long term. Flexibility. SIPs offer flexibility in terms of investment amount and tenure. Investors can start with a small investment and increase it gradually as per their convenience. Additionally, they can choose the duration of the SIP, which can be open-ended or for a specific period. Automatic investments. SIPs enable automatic investments, as the invested amount is deducted automatically from the investor's bank account. This simplifies the investment process and ensures regular investments without requiring manual intervention. Compounding benefits. Through regular investments, SIPs allow investors to benefit from the power of compounding. Over time, the investment grows not only from the contributions but also from the returns generated by the mutual fund. Systematic Transfer Plans, STPs. A systematic transfer plan, STP, is an investment strategy that enables investors to transfer a fixed amount systematically from one mutual fund scheme to another within the same fund house. Here's how STPs work. Capital deployment. STPs provide a mechanism to gradually transfer investments from one mutual fund scheme to another. It allows investors to deploy funds strategically based on their investment objectives, market conditions, or asset allocation preferences. Risk management. STPs help manage risk by gradually shifting investments from one scheme to another. For example, an investor can transfer investments from an equity fund to a debt fund to reduce exposure to equity market volatility as their investment horizon shortens. Automatic transfers. Similar to SIPs, STPs can be set up for automatic transfers. Investors can specify the amount to be transferred and the frequency, example, monthly or quarterly. The transfers can be made based on a fixed amount or a certain percentage of the investment value. Flexibility. STPs offer flexibility in terms of the transfer frequency, amount, and the source and destination mutual fund schemes. Investors can customize the STP to align with their investment goals and preferences. Tax efficiency. STPs can be useful in managing tax implications. For instance, investors can use STPs to transfer capital gains from an equity fund to a debt fund, potentially benefiting from the differential tax treatment between the two. Both SIPs and STPs provide investors with disciplined investment options and help in managing investments systematically. They encourage regular savings, reduce the impact of market volatility, and offer flexibility in terms of investment amounts and tenures. These strategies can be used based on an investor's goals, risk tolerance, and investment horizon. It's important to note that while SIPs and STPs can be beneficial investment strategies, they do not guarantee profits or protect against losses. Investors should carefully assess their investment objectives, risk tolerance, and consult with financial professionals or investment advisors to determine the suitability of SIPs or STPs in their overall investment plan. Risk and return relationship, standard deviation, beta, and alpha. Understanding the relationship between risk and return is essential for investors when evaluating investment opportunities. Different risk measures, such as standard deviation, beta, and alpha, help assess the risk-return trade-off of an investment. Let's explore these measures and their significance in analyzing the risk and return relationship. Standard deviation. Standard deviation is a commonly used measure of investment risk. It quantifies the historical volatility or dispersion of an investment's returns around its average or expected return. A higher standard deviation indicates greater volatility and potential for larger fluctuations in returns, representing a higher level of risk. The relationship between standard deviation and return is typically positive. Investments with higher standard deviations generally have the potential for higher returns, but they also come with a higher level of risk. Conversely, investments with lower standard deviations tend to have lower risk but may offer relatively lower returns. Beta measures the sensitivity of an investment's returns to movements in the overall market. It compares the investment's historical price movements to a benchmark index, such as the S&P 500 for equities. A beta of 1 indicates that the investment's returns move in line with the market. A beta greater than 1 suggests higher volatility or sensitivity to market movements, while a beta less than 1 indicates lower volatility or sensitivity. In terms of the risk-return relationship, beta provides insights into systematic or market risk. Higher beta investments tend to have higher potential returns but also higher risk, as they are more susceptible to market fluctuations. Lower beta investments, on the other hand, may offer relatively lower returns but potentially provide more stability during market downturns. Alpha measures an investment's risk-adjusted performance relative to a benchmark. It represents the excess return generated by an investment after adjusting for its beta. A positive alpha suggests that the investment outperformed the benchmark, while a negative alpha indicates underperformance. Alpha captures the skill of the investment manager in generating returns beyond what would be expected based on the market risk, beta. It provides insights into the investment manager's ability to add value through security selection, timing decisions, or other strategies. Positive alpha implies that the investment has achieved returns higher than what would be predicted by its market risk, potentially indicating skillful management. In terms of the risk-return relationship, alpha helps assess whether an investment's returns justify the level of risk taken. A positive alpha indicates the potential for higher returns relative to the risk undertaken, suggesting favorable risk-adjusted performance. It's important to note that standard deviation, beta, and alpha are not the only factors to consider when assessing the risk-return relationship of an investment. They should be evaluated in conjunction with other factors such as investment objectives, investment horizon, correlation with other investments, and the overall portfolio's risk and return characteristics. By considering measures like standard deviation, beta, and alpha, investors can gain insights into the risk and return trade-off of an investment. These measures assist in evaluating investment opportunities, comparing different investments, and making informed decisions aligned with individual risk tolerance and investment objectives. Evaluating risk-adjusted returns, Sharpe ratio, Trainer ratio, and Sortino ratio. When evaluating investment performance, it's important to consider risk-adjusted returns to assess how well an investment has performed relative to the risk taken. Risk-adjusted measures provide insights into how efficiently an investment has generated returns, considering the level of risk assumed. 3 commonly used risk-adjusted ratios are the Sharpe ratio, Trainer ratio, and Sortino ratio. Let's explore these ratios and their significance in evaluating risk-adjusted returns. Sharpe ratio. The Sharpe ratio measures the risk-adjusted return of an investment by considering the excess return earned above a risk-free rate per unit of volatility, as measured by standard deviation. Here's how the Sharpe ratio is calculated. Sharpe ratio equals average return of the investment risk-free rate / standard deviation of the investment. A higher Sharpe ratio indicates a better risk-adjusted performance, as it signifies higher excess returns relative to the volatility, risk, of the investment. The Sharpe ratio allows for a comparison of different investments' risk-adjusted performance, enabling investors to assess how efficiently returns have been generated in relation to the level of risk taken. Trainer ratio. The the Trainer ratio evaluates the risk-adjusted return of an investment by considering the excess return earned above the risk-free rate per unit of systematic risk, as measured by beta. The Trainer ratio is calculated as follows. Trainer ratio equals average return of the investment risk-free rate / beta of the investment. The Trainer ratio focuses on the systematic risk of an investment, representing the risk that cannot be diversified away. A higher Trainer ratio suggests a better risk-adjusted performance, indicating higher excess returns per unit of systematic risk. Sortino ratio. The Sortino ratio is similar to the Sharpe ratio, but it focuses on downside risk instead of total volatility. It measures the excess return earned above the risk-free rate per unit of downside deviation, a measure of downside volatility. The Sortino ratio is calculated as follows. Sortino ratio equals average return of the investment risk-free rate / downside deviation of the investment. The Sortino ratio provides a more focused assessment of risk-adjusted performance by considering only the downside volatility of returns. It highlights the investment's ability to generate positive returns while minimizing the downside risk. A higher Sortino ratio indicates better risk-adjusted performance, suggesting higher excess returns relative to the downside volatility. It's important to note that these risk-adjusted ratios have limitations and should not be the sole basis for investment decisions. They provide insights into risk-adjusted performance but do not consider other factors such as investment objectives, time horizon, or correlation with other investments. When evaluating risk-adjusted returns, it's recommended to consider multiple ratios, such as the Sharpe ratio, Trainer ratio, and Sortino ratio, along with other qualitative and quantitative factors. These ratios help assess how efficiently an investment has generated returns relative to the risk taken, aiding in informed investment decisions and portfolio management. Assessing the risk profile of different types of mutual funds. Mutual funds come in various types, each with its own risk profile. Assessing the risk profile of different types of mutual funds is crucial for investors to align their investment choices with their risk tolerance and investment objectives. Here's an overview of the risk profiles associated with different types of mutual funds. Equity funds. Equity funds invest primarily in stocks or shares of companies. These funds have the potential for higher returns but also carry higher risk due to the volatility of stock markets. The risk profile of equity funds can vary based on factors such as investment style, example, growth or value, market capitalization, example, large cap, mid cap, or small cap, and geographic focus, example, domestic or international. Generally, equity funds are considered to have a higher risk profile compared to other types of mutual funds. Debt funds. Debt funds primarily invest in fixed income instruments such as government bonds, corporate bonds, treasury bills, and other debt securities. Debt funds generally offer lower potential returns compared to equity funds but also carry lower risk. The risk profile of debt funds depends on factors such as the credit quality of the underlying securities, interest rate sensitivity, and duration. Government bonds and high-quality corporate bonds tend to be lower-risk options, while lower-rated bonds or those with longer durations may carry higher risk. Balanced or hybrid funds. Balanced or hybrid funds aim to provide a combination of equity and debt exposure. These funds allocate a portion of their assets to equities and the remaining to fixed-income securities. The risk profile of balanced funds depends on the allocation between equity and debt components. Aggressive balanced funds with a higher equity allocation may carry higher risk, while conservative balanced funds with a higher debt allocation may have lower risk. Index funds. Index funds aim to replicate the performance of a specific market index, such as the S&P 500 or a bond index. The risk profile of index funds is typically lower compared to actively managed funds because they seek to match the returns of the underlying index rather than outperform it. However, index funds still carry market risk, as their performance is tied to the index they track. Sector or theme-based funds. Sector or theme-based funds focus on specific sectors or themes such as technology, healthcare, energy, or sustainability. These funds carry a higher risk compared to diversified funds as they are concentrated in a particular sector or theme. The risk profile of sector funds is influenced by the performance and trends of the targeted sector or theme. Money market funds. Money market funds invest in short-term, high-quality debt instruments such as treasury bills, commercial paper, and certificates of deposit. These funds aim to provide capital preservation and stability of returns. Money market funds are generally considered low-risk investments, providing a safe haven for short-term cash reserves. It's important to note that risk profiles can vary even within the same type of mutual fund. For example, within the equity category, a large cap fund may have a lower risk profile compared to a small cap fund due to differences in market capitalization and potential volatility. When assessing the risk profile of different types of mutual funds, investors should consider factors such as historical performance, volatility, fund objectives, underlying securities, investment style, asset allocation, and the fund manager's expertise. By understanding the risk profiles of different types of mutual funds, investors can make informed decisions aligned with their risk tolerance, investment goals, and time horizon. It's advisable to carefully review the fund's documentation, including the prospectus, scheme information document, and past performance, and seek guidance from financial professionals or investment advisors to ensure the chosen mutual funds align with their risk appetite and investment objectives. Exploring investment strategies for different market conditions. Investment strategies should be adaptable to different market conditions, as market dynamics can vary over time. Here are some investment strategies that can be employed based on different market conditions. Bull market. A bull market refers to a period of rising stock prices and optimism among investors. Strategies for a bull market include growth investing. Focus on investing in companies with strong growth potential. Look for companies with solid earnings growth, innovative products or services, and expanding market share. Sector rotation. Identify sectors that are expected to outperform in a bull market and allocate investments accordingly. Sector rotation involves adjusting the portfolio's sector exposure based on the changing market conditions. Buy and hold. In a bull market, some investors follow a buy and hold strategy, aiming to capture long-term market gains by holding onto quality investments. This strategy requires patience and a long-term investment horizon. Bear market. A bear market refers to a period of declining stock prices and negative investor sentiment. Strategies for a bear market include defensive investing. Focus on defensive sectors such as consumer staples, healthcare, and utilities, which tend to be less impacted by economic downturns. Risk management. Employ risk management techniques like stop-loss orders or trailing stops to limit potential losses. These techniques can help protect against severe market declines. Diversification. Maintain a well-diversified portfolio across different asset classes, sectors, and regions. Diversification helps spread risk and can mitigate losses during a bear market. Value investing. Look for undervalued stocks that may offer good long-term prospects but have temporarily declined due to market conditions. Value investing involves identifying assets trading below their intrinsic value. Volatile market. A volatile market is characterized by rapid and significant price fluctuations. Strategies for a volatile market include active trading. Active traders may capitalize on short-term price movements by employing strategies such as technical analysis, momentum trading, or swing trading. Risk mitigation. Consider investments that are less volatile or have defensive characteristics, such as bonds, dividend-paying stocks, or alternative investments. Market timing. Employ market timing strategies to enter or exit the market based on anticipated short-term trends or market indicators. However, market timing can be challenging and requires careful analysis. Dollar cost averaging. Regularly invest a fixed amount at predetermined intervals. This strategy helps mitigate the impact of short-term market volatility by buying more shares when prices are low and fewer shares when prices are high. Sideways market. A sideways or range-bound market refers to a period when the market moves within a relatively narrow price range. Strategies for a sideways market include range trading. Identify support and resistance levels within the price range and consider buying at support levels and selling at resistance levels. This approach aims to capture short-term price fluctuations within the range. Income-generating investments. Focus on investments that generate income, such as dividend-paying stocks, bonds, or real estate investment trusts, REITs. These investments can provide stable income during a sideways market. Option strategies. Utilize option strategies like selling covered calls or buying protective puts to generate income or protect against downside risk in a sideways market. Contrarian investing. Look for opportunities that are contrary to prevailing market sentiment. Contrarian investors believe that market extremes can present buying or selling opportunities when the consensus view is overly optimistic or pessimistic. It's important to note that these strategies are general approaches and may not guarantee profits or protect against losses. Individual circumstances, risk tolerance, and investment goals should be considered when implementing these strategies. Additionally, seeking guidance from financial professionals or investment advisors can provide personalized recommendations based on specific market conditions and investor objectives. By exploring different investment strategies for different market conditions, investors can adapt to changing market dynamics and potentially enhance their investment outcomes. Flexibility in a well-thought-out investment plan that aligns with individual risk tolerance and goals are key to successful investing. Tax implications of investing in mutual funds, capital gains tax, dividend distribution tax, and indexation. Investing in mutual funds can have tax implications that investors should be aware of. Understanding the tax rules associated with mutual fund investments can help investors make informed decisions and effectively manage their tax liabilities. Here are some key tax considerations related to investing in mutual funds. Capital gains tax. Capital gains tax is applicable when investors sell their mutual fund units and realize a profit. The tax treatment depends on the holding period and the type of mutual fund. Short-term capital gains, STCG. If mutual fund units are held for less than 36 months, 24 months for immovable property funds, the gains are considered short-term capital gains. STCG is added to the investor's taxable income and taxed at their applicable income tax slab rate. Long-term capital gains, LTCG. If mutual fund units are held for 36 months or more, 24 months for immovable property funds, the gains are considered long-term capital gains. LTCG on equity-oriented funds exceeding 1 Indian rupee lakh is subject to a 10% tax without indexation benefits. For debt-oriented funds, LTCG is taxed at 20% with the benefit of indexation. Note, equity-oriented funds include funds where the equity exposure is 65% or more. Debt-oriented funds include funds where the equity exposure is less than 65%. Dividend distribution tax, DDT. Dividend distribution tax is a tax levied on the distribution of dividends by mutual funds to their unit holders. The tax is paid by the mutual fund itself, and the dividend received by the unit holder is tax-free in their hands. However, DDT reduces the overall return on investment. In the Union Budget 2020, the DDT was abolished. Instead, the dividend received by unit holders is now taxed as per their applicable income tax slab rates. This change makes dividends taxable in the hands of the investors, rather than the mutual fund. Indexation benefit. Indexation is a mechanism provided by the tax authorities to adjust the cost of acquiring an asset based on the inflation index. Indexation helps account for the impact of inflation on the cost of investment, reducing the tax liability on long-term capital gains from debt-oriented mutual funds. By applying the indexation benefit, the cost of acquisition is adjusted upwards, potentially reducing the taxable gains and the corresponding tax liability. Indexation benefit is not applicable to equity-oriented mutual funds, as LTCG from these funds exceeding 1 Indian rupee lakh is taxed at a flat rate without the benefit of indexation. Investors should keep the following points in mind regarding tax implications. Tax laws and rates are subject to change, and it's important to stay updated with the latest tax regulations and consult with tax professionals or advisors. Investors should maintain accurate records of their investments, including purchase price, sale price, and holding period, to calculate accurate capital gains and claim applicable deductions or exemptions. Tax-saving mutual fund schemes, such as equity-linked savings schemes (ELSS), offer tax benefits under Section 80C of the Income Tax Act. Investments in ELSS are eligible for deduction up to 1.5 Indian rupees lakhs per year. Investors in mutual funds should consider their individual tax brackets, investment goals, and investment horizon to make informed decisions. It's advisable for investors to consult with tax professionals or financial advisors to understand the specific tax implications of their mutual fund investments based on their individual circumstances. They can provide personalized guidance and help optimize tax strategies within the legal framework to minimize tax liabilities and maximize after-tax returns. Understanding tax-saving mutual funds, equity-linked savings schemes (ELSS). Equity-linked savings schemes (ELSS) are tax-saving mutual funds that offer investors the dual benefit of potential capital appreciation and tax savings. ELSS funds are designed to encourage long-term equity investments while providing tax benefits under Section 80C of the Income Tax Act in India. Here's an overview of ELSS and their key features. Tax benefits. ELSS funds offer tax benefits to investors under Section 80C of the Income Tax Act. Investments in ELSS funds are eligible for deduction up to 1.5 Indian rupees lakhs per financial year, helping individuals reduce their taxable income. The amount invested in ELSS qualifies for the deduction in the year of investment. Lock-in period. ELSS funds have a mandatory lock-in period of 3 years, which means that investors cannot redeem or sell their units before completing this period. The lock-in period is calculated from the date of each investment, and subsequent investments in the same ELSS fund will have their lock-in periods separately determined. Equity exposure. ELSS funds primarily invest in equity and equity-related instruments, with a minimum investment requirement of 80% in equities. This equity exposure allows investors to participate in the potential growth of the stock market. However, it's important to note that equity investments come with market-related risks and the possibility of volatility. Diversification. ELSS funds typically diversify their equity holdings across different sectors and companies to mitigate concentration risk. Diversification helps spread the investment risk and reduce the impact of any single stock or sector on the overall performance of the fund. Potential for capital appreciation. As ELSS funds invest in equities, they have the potential to generate capital appreciation over the long term. The performance of ELSS funds is linked to the performance of the underlying equity market. It's important for investors to have a long-term investment horizon to potentially benefit from market upswings and manage short-term market volatility. Systematic investment option. ELSS funds often offer a systematic investment option (SIP), allowing investors to invest a fixed amount at regular intervals. SIPs help inculcate disciplined investing habits and provide the benefit of rupee cost averaging, reducing the impact of short-term market fluctuations. Flexibility. Investors have the flexibility to invest in ELSS funds through lump sum investments or through systematic investment plans, SIPs, based on their convenience and financial goals. However, it's important to note that each investment in an ELSS fund has a separate lock-in period. Fund selection. When selecting an ELSS fund, investors should consider various factors such as the fund's historical performance, fund manager's track record, investment philosophy, expense ratio, portfolio composition, and risk management practices. Reviewing these factors can help investors make an informed decision based on their risk tolerance and investment objectives. It's important to note that while ELSS funds offer tax benefits and the potential for capital appreciation, investing in them involves market-related risks. Investors should carefully evaluate their risk tolerance, investment horizon, and financial goals before investing in ELSS funds. Diversification and regular review of the investment portfolio are important aspects of successful investing. It is advisable for investors to consult with financial advisors or professionals to understand the suitability of ELSS funds based on their individual financial circumstances, risk appetite, and tax planning requirements. Tax-efficient investment strategies and portfolio rebalancing. Tax-efficient investment strategies and portfolio rebalancing can help investors optimize their after-tax returns and manage their tax liabilities effectively. By implementing these strategies, investors can potentially minimize the impact of taxes on their investment gains. Here are key considerations for tax efficiency and portfolio rebalancing. Tax-efficient investment strategies. A. Asset location. Different types of investments have varying tax characteristics. Consider placing tax-efficient investments, such as tax-exempt bonds or index funds, in taxable accounts. Place tax-inefficient investments, such as actively managed funds or high-dividend stocks, in tax-advantaged accounts like individual retirement accounts (IRAs) or 401(k)s. B. Tax-advantaged accounts. Take advantage of tax-advantaged accounts, such as IRAs or 401(k)s, which offer tax benefits like tax-deferred growth or tax-free withdrawals. Contribute to these accounts to maximize tax advantages and potentially reduce your current taxable income. C. Tax loss harvesting. Capitalize on tax loss harvesting by selling investments that have experienced a loss to offset capital gains in your portfolio. By strategically realizing losses, you can offset taxable gains and potentially reduce your overall tax liability. D. Buy and hold strategy. A long-term buy and hold strategy can help defer taxes. By holding investments for more than a year, you can potentially qualify for long-term capital gains tax rates, which are often lower than short-term rates. E. Tax-aware investing. Consider tax implications when making investment decisions. For example, be mindful of the potential tax impact of dividend distributions or capital gains distributions from mutual funds, especially in taxable accounts. Portfolio rebalancing. Maintain asset allocation. Regularly review your portfolio to ensure it aligns with your target asset allocation. Rebalance your portfolio by buying or selling assets to bring it back in line with your desired allocation. This helps manage risk and ensures your portfolio remains in line with your investment objectives. B. Tax-efficient rebalancing. When rebalancing your portfolio, consider the tax implications of selling investments. Sell investments with losses to offset gains and minimize the tax impact. Additionally, rebalance within tax-advantaged accounts, if possible, to avoid triggering taxable events. C. Use new contributions. Instead of selling existing investments to rebalance, use new contributions to adjust the allocation. This approach can help minimize transaction costs and potential tax consequences. D. Consider tax efficiency. When adding new investments to your portfolio, consider the tax efficiency of the asset. Investments with lower turnover and tax-efficient characteristics, such as index funds, may be more suitable for taxable accounts. E. Rebalancing thresholds. Determine appropriate rebalancing thresholds that trigger portfolio adjustments. Setting specific thresholds, such as a deviation of 5% from the target allocation, helps ensure timely rebalancing without excessive trading. It's important to note that tax laws and regulations may change over time, and individual tax situations can vary. Therefore, it's advisable to consult with tax professionals or financial advisors to understand the specific tax implications and strategies suitable for your circumstances. By implementing tax-efficient investment strategies and periodically rebalancing your portfolio, you can optimize your after-tax returns, manage your tax liabilities, and stay on track towards achieving your long-term investment goals. Sector funds and thematic funds, investing in specific industries or themes. Sector funds and thematic funds are mutual funds that focus on specific industries or themes. These funds allow investors to target their investments in sectors or themes they believe will outperform the broader market. Let's explore sector funds and thematic funds in more detail. Sector funds. Sector funds concentrate their investments in a specific industry or sector, such as technology, healthcare, energy, financial services, or consumer goods. Here are some key points to consider. Targeted exposure. Sector funds provide investors with targeted exposure to a particular industry or sector. This allows investors to align their investment strategy with their views on specific sectors they believe will perform well. Risk and volatility. Sector funds tend to be more volatile than diversified funds because their performance is closely tied to the fortunes of a particular industry or sector. The performance of sector funds can be influenced by factors specific to that industry, such as regulatory changes, technological advancements, or market conditions impacting the sector. Specialized expertise. Sector funds are managed by fund managers with specialized knowledge and expertise in the targeted industry or sector. Their in-depth understanding of the industry dynamics can potentially lead to better investment decisions. Sector rotation. Sector funds can be used as part of a sector rotation strategy, where investors rotate their investments among different sectors based on anticipated market trends or economic cycles. This strategy aims to take advantage of sectors that are expected to outperform while avoiding those that may underperform. Concentration risk. Since sector funds focus on a specific industry or sector, they are subject to concentration risk. If the targeted sector faces challenges or underperforms, the fund's returns may be adversely affected. Thematic funds. Thematic funds invest in companies that are aligned with a specific theme or trend, irrespective of the industry or sector they belong to. Thematic funds allow investors to capitalize on emerging trends and transformative themes. Here are some key points to consider. Thematic exposure. Thematic funds provide exposure to specific themes or trends such as technology innovation, clean energy, artificial intelligence, healthcare innovation, or e-commerce. These funds invest in companies across multiple sectors that are driving or benefiting from the identified theme. Growth potential. Thematic funds target sectors and companies that have the potential for significant growth due to their association with the identified theme. Investors who believe in the long-term growth prospects of a particular theme may find thematic funds appealing. Higher risk and volatility. Thematic funds can be riskier and more volatile than diversified funds because they focus on specific themes that may have uncertain outcomes or face regulatory, technological, or market-related challenges. Active management. Thematic funds are typically actively managed to identify and invest in companies that align with the targeted theme. Active management allows the fund manager to make informed investment decisions based on their research and analysis. Research and monitoring. Thematic investing requires continuous monitoring and analysis of evolving trends, industry developments, and market dynamics. Investors should ensure that the fund manager has a robust research process and a deep understanding of the thematic area. It's important to note that sector funds and thematic funds may not be suitable for all investors. They carry higher risks and can be more volatile compared to diversified funds. Investors considering sector funds or thematic funds should carefully evaluate their risk tolerance, investment horizon, and the specific investment objectives they wish to achieve. Furthermore, it's advisable to assess the historical performance, track record of the fund manager, expense ratios, and the fund's investment strategy before investing in sector funds or thematic funds. Investors should also consider diversifying their portfolios and avoid overconcentration in a single sector or theme to mitigate risk. As with any investment, investors should consult with financial professionals or investment advisors to determine the suitability of sector funds or thematic funds based on their individual financial circumstances, risk tolerance, and investment goals. Exchange-traded funds, ETFs, and mutual funds are both popular investment vehicles that offer diversification and professional management. While they share some similarities, there are also key differences between ETFs and mutual funds. Let's explore the similarities and differences. Similarities. Diversification. Both ETFs and mutual funds provide investors with access to a diversified portfolio of securities. By pooling money from multiple investors, these funds can invest in a wide range of assets, such as stocks, bonds, or commodities. Professional management. ETFs and mutual funds are managed by professional portfolio managers who make investment decisions on behalf of the fund. The managers conduct research, select securities, and monitor the fund's performance. Liquidity. Both ETFs and mutual funds offer investors the ability to buy or sell shares on any trading day. They provide investors with liquidity, allowing them to enter or exit their investment positions conveniently. Transparency. Both ETFs and mutual funds disclose their holdings to investors on a regular basis. This transparency allows investors to see the underlying securities in the fund's portfolio. Differences. Structure. ETFs are structured as exchange-traded products, which means they are traded on stock exchanges throughout the day, similar to individual stocks. On the other hand, mutual funds are bought and sold at the end of the trading day at the fund's net asset value, NAV, price. Trading flexibility. ETFs can be bought or sold throughout the trading day at market prices. This allows investors to take advantage of intraday price fluctuations and use advanced trading strategies, such as limit orders or stop orders. Mutual funds, on the other hand, are priced at the end of the trading day and can only be bought or sold at the NAV price. Costs. ETFs tend to have lower expense ratios compared to mutual funds. This is because ETFs typically passively track an index, aiming to replicate its performance, while many mutual funds are actively managed, which involves higher research and management costs. Tax efficiency. ETFs are generally more tax efficient compared to mutual funds. ETFs have a unique structure that allows for in-kind creation and redemption of shares, which can minimize capital gains distributions. Mutual funds, especially actively managed funds, may have higher capital gains distributions due to buying and selling securities within the fund. Investment minimums. ETFs do not typically have investment minimums, allowing investors to buy as little as one share. Mutual funds may have minimum investment requirements, which can vary depending on the fund. Variety and accessibility. ETFs offer a wide range of investment options, including broad market index funds, sector-specific funds, international funds, and bond funds. They provide investors with access to different markets and asset classes. Mutual funds also offer diverse investment options, but their range may be broader, including specialized funds, target date funds, and alternative investment funds. It's important to note that while ETFs and mutual funds have different characteristics, both can play a role in a well-diversified investment portfolio. Investors should consider their investment goals, risk tolerance, trading preferences, and tax considerations when choosing between ETFs and mutual funds. Seeking guidance from financial professionals or investment advisors can help investors assess their specific needs and select the most suitable investment vehicle based on their individual circumstances. International mutual funds and investing in global markets. International mutual funds provide investors with the opportunity to diversify their investment portfolios by gaining exposure to global markets. These funds invest in securities issued by companies or governments outside the investor's home country. Investing in international mutual funds offers several potential benefits and considerations. Benefits of international mutual funds. Geographic diversification. International mutual funds allow investors to diversify their portfolios beyond their domestic markets. By investing in different countries and regions, investors can potentially reduce the risk associated with concentration in a single market or economy. Diversification across countries can help spread risk and capture opportunities in various regions. Access to global markets. International mutual funds offer access to a wide range of global markets and investment opportunities. Investors can participate in the growth and development of economies and industries around the world, potentially benefiting from sectors or regions that may be outperforming their domestic market. Exposure to emerging markets. Many international mutual funds invest in emerging markets, which are characterized by rapid economic growth and potential investment opportunities. These markets can offer higher growth potential but also come with higher volatility and risks. Investing in international mutual funds can provide exposure to these emerging economies and their potential long-term growth prospects. Currency diversification. Investing in international mutual funds can provide exposure to different currencies, which can serve as a hedge against currency risk or offer potential currency appreciation. Currency movements can impact investment returns, and having exposure to multiple currencies can help balance risks associated with foreign exchange fluctuations. Considerations for investing in international mutual funds. Market and currency risks. International investments come with inherent risks, including market risk specific to each country, geopolitical risks, and currency fluctuations. Political instability, regulatory changes, economic conditions, and cultural differences can all impact the performance of international markets. Investors should be prepared for volatility and the potential impact of currency exchange rate movements on their investment returns. Country and sector-specific risks. Each country and region has its own economic, political, and regulatory factors that can affect investment performance. Investors should consider country-specific risks, such as legal and political stability, economic growth prospects, and industry-specific risks when investing in international mutual funds. Research and due diligence. Conduct thorough research and due diligence when selecting international mutual funds. Consider factors such as the fund's investment objectives, track record, portfolio holdings, fund managers' expertise, expense ratios, and risk management practices. Assess the fund's exposure to various regions, industries, and currencies to ensure it aligns with your investment goals and risk tolerance. Tax and legal considerations. Investing in international mutual funds may have tax implications, including withholding taxes on dividends or capital gains. Investors should understand the tax regulations in their home country and any tax treaties in place with the countries where the fund invests. It's advisable to consult with tax professionals or financial advisors to understand the tax implications of international investing. Currency conversion costs. When investing in international mutual funds, investors may incur currency conversion costs. These costs can arise when purchasing or selling units of the fund or when receiving dividends or capital gains distributions in a different currency. Consider the impact of currency conversion costs on investment returns. Investing in international mutual funds can provide opportunities for diversification and potential exposure to global growth. However, it's essential to carefully evaluate the risks and opportunities associated with different countries, regions, and currencies. Investors should consider their risk tolerance, investment goals, and time horizon before allocating funds to international mutual funds. Consulting with financial professionals or investment advisors can provide valuable insights and help investors navigate the complexities of international investing, including selecting suitable international mutual funds based on individual circumstances. Value investing, growth investing, and other investment styles. Different investment styles reflect distinct approaches to selecting investments and managing portfolios. Investors often choose investment styles based on their risk tolerance, investment goals, and market outlook. Let's explore some common investment styles. Value investing. Value investing is a strategy that focuses on identifying undervalued stocks or assets that are trading below their intrinsic value. Value investors believe that the market may have overlooked or undervalued these investments, presenting an opportunity for potential price appreciation. Key features of value investing include fundamental analysis. value investors analyze a company's financial statements, earnings, assets, and other fundamental factors to assess its intrinsic value. Bargain hunting, value investors look for stocks or assets that are trading at a discount relative to their intrinsic value. They seek companies with solid financials, a favorable price-to-earnings ratio, or other metrics that indicate the potential for future growth. Long-term perspective, value investing often involves a long-term investment horizon, as it may take time for the market to recognize the underlying value and for prices to adjust accordingly. Growth investing focuses on identifying companies that are expected to experience above-average earnings growth compared to the broader market. Growth investors seek stocks of companies with strong growth prospects, innovative products or services, expanding market share, or disruptive technologies. Key features of growth investing include forward-looking approach. Growth investors focus on future potential and earnings growth rather than current valuation metrics. They believe that investing in companies with strong growth prospects will result in higher returns over time. Emphasis on momentum. Growth investors often look for stocks that are exhibiting positive price momentum or have the potential to generate significant future market demand. Higher valuations. Growth stocks tend to trade at higher valuation multiples, such as price-to-earnings ratios, compared to value stocks. This is because investors are willing to pay a premium for the expected future growth of these companies. Income investing, also known as dividend investing, focuses on generating a steady stream of income from investments. Income investors seek stocks, bonds, or other income-generating assets that offer regular dividend payments or interest income. Key features of income investing include dividend yield. Income investors look for stocks or funds with attractive dividend yields, which is the dividend payment divided by the stock price. They seek investments that offer reliable and consistent income. Cash flow considerations. Income investors analyze the cash flow of companies or the interest payment capacity of bonds to ensure the sustainability of dividends or interest income. Lower capital appreciation expectations. Income investing generally prioritizes generating income over significant capital appreciation. The focus is on stable and reliable income streams rather than aggressive growth. Index investing involves investing in a portfolio that mirrors the composition and performance of a specific market index, such as the S&P 500. Rather than trying to outperform the market, index investors aim to match the returns of the index. Key features of index investing include passive management. Index funds or exchange-traded funds (ETFs) are passively managed, aiming to replicate the performance of the underlying index. They have lower expense ratios compared to actively managed funds. Diversification. Index funds provide broad market exposure, as they hold a diversified portfolio of stocks or other assets within the index. This diversification helps mitigate risk by spreading investments across different sectors and companies. Efficient market hypothesis. Index investing is based on the belief that markets are efficient and that it is challenging for active managers to consistently outperform the market over the long term. Thus, index investors seek to capture the overall market returns. It's important to note that these investment styles are not mutually exclusive, and many investors adopt a combination of styles in their portfolios. Other investment styles, such as momentum investing, contrarian investing, or socially responsible investing, also exist and cater to specific investor preferences and objectives. Investors should carefully evaluate their risk tolerance, investment goals, and time horizons when choosing an investment style. Diversification and a long-term perspective are key components of successful investing, regardless of the chosen investment style. Seeking guidance from financial professionals or investment advisors can provide valuable insights and help align investment styles with individual circumstances and objectives. Techniques for monitoring mutual fund investments: NAV tracking, performance analysis, and periodic reviews. Monitoring your mutual fund investments is essential to stay informed about their performance and ensure they align with your investment goals. By employing various monitoring techniques, you can assess the progress of your investments and make informed decisions. Here are 3 key techniques for monitoring mutual fund investments. Net asset value, NAV, tracking. Net asset value, NAV, is the per unit value of a mutual fund. It represents the fund's total assets minus liabilities, divided by the number of outstanding units. Monitoring the NAV of your mutual fund investments helps track their performance over time. Here's how to effectively track NAV. Regular checkups. Monitor the NAV of your mutual fund investments periodically, such as monthly or quarterly. NAV updates are typically available on the fund company's website, financial news platforms, or investment portals. Compare against benchmark. Compare the NAV performance of your mutual fund with its benchmark index or relevant peer group. This allows you to assess whether the fund is performing better or worse than its peers or the market as a whole. Look for consistency. Monitor the trend in NAV over time. Look for consistency in growth, stability, or any significant deviations from historical performance. Consistent positive growth is generally favorable, while frequent fluctuations may warrant further analysis. Performance analysis. Analyzing the performance of your mutual fund investments involves assessing various performance metrics and evaluating their relative returns. Here are some performance analysis techniques. Return analysis. Evaluate the fund's historical returns over different time periods, example, 1 year, 3 years, 5 years, and compare them with appropriate benchmarks or peer groups. This analysis helps gauge how the fund has performed over different market conditions and timeframes. Risk-adjusted returns. Consider risk-adjusted metrics such as the Sharpe ratio or the Sortino ratio. These ratios measure a fund's risk-adjusted returns, accounting for the level of risk taken to achieve the returns. Higher ratios indicate better risk-adjusted performance. Rolling returns. Examine rolling returns to understand a fund's consistency and performance over various holding periods. Rolling returns track the fund's returns over consecutive periods, such as 1-year rolling returns over multiple years. This analysis provides insights into long-term performance trends. Expense ratio evaluation. Assess the expense ratio, which reflects the costs associated with managing the fund. Compare the fund's expense ratio with similar funds to ensure it is reasonable and competitive. Periodic reviews. Conducting periodic reviews of your mutual fund investments helps ensure they remain aligned with your investment goals and evolving market conditions. Here's how to approach periodic reviews. Review investment objectives. Assess whether the mutual fund's investment objectives are still aligned with your financial goals, risk tolerance, and time horizon. Changes in personal circumstances or market conditions may warrant adjustments to your investment strategy. Portfolio rebalancing. Consider rebalancing your portfolio if the allocation to a specific mutual fund has deviated significantly from your target allocation. Rebalancing involves selling or buying assets to restore the desired asset allocation. Fund manager assessment. Stay informed about any changes in the fund's management team or investment strategy. Evaluate the credentials and track record of the fund manager to ensure confidence in their ability to manage the fund effectively. Stay informed, keep up with news, updates, and any regulatory changes related to the mutual fund industry or the specific funds you have invested in. This information can provide valuable insights into the fund's prospects and potential risks. Remember, past performance is not indicative of future results, and monitoring alone does not guarantee investment success. It's advisable to seek guidance from financial professionals or investment advisors who can provide personalized recommendations based on your specific investment goals, risk tolerance, and market conditions. Regular monitoring and periodic reviews of your mutual fund investments will help you make informed decisions and take appropriate actions to keep your portfolio on track towards achieving your financial objectives. Portfolio rebalancing. When and how to make adjustments. Portfolio rebalancing is the process of realigning the asset allocation of your investment portfolio back to your desired target allocation. Over time, as different assets perform differently, the original asset allocation can deviate from your intended investment strategy. Rebalancing helps ensure that your portfolio remains in line with your risk tolerance and investment goals. Here are some key considerations for when and how to make portfolio adjustments. When to rebalance. There is no fixed rule for when to rebalance your portfolio, as it depends on your investment strategy, risk tolerance, and market conditions. Here are some common triggers for rebalancing. Time-based rebalancing. Rebalance your portfolio at regular intervals, such as annually, semi-annually, or quarterly. This approach ensures systematic adjustments regardless of market conditions and helps maintain a disciplined investment approach. Threshold-based rebalancing. Set predetermined thresholds for each asset class or investment category within your portfolio. When the actual allocation deviates from the target allocation by a certain percentage, example, 5% or 10%, trigger a rebalancing action. This approach allows for adjustments based on specific asset class performance. Calendar events or life changes. Consider rebalancing during significant life events such as job changes, retirement, or major financial milestones. Additionally, rebalancing may be appropriate after major market movements or changes in your risk tolerance. Opportunistic rebalancing. Take advantage of market opportunities or significant market dislocations to rebalance your portfolio. This approach involves making adjustments when specific assets or sectors are significantly undervalued or overvalued, based on your analysis. How to rebalance. Once you have determined that rebalancing is necessary, follow these steps to make adjustments to your portfolio. Review asset allocation. Assess the current allocation of your portfolio and compare it with your target allocation. Identify the asset classes or investment categories that have deviated significantly from their target percentages. Determine rebalancing strategy. Decide on a strategy to realign your portfolio. You have two main options: buy and sell. Sell a portion of the overallocated assets and use the proceeds to buy more of the underallocated assets. This approach brings the portfolio back to the desired target allocation. B. New contributions. Adjust future contributions or new investments to focus on underallocated assets. This approach gradually brings the portfolio back to the target allocation over time without incurring transaction costs. Consider tax implications. Be mindful of potential tax consequences when rebalancing taxable accounts. Selling investments may trigger capital gains taxes. Consider tax-efficient strategies such as selling tax loss positions to offset gains or utilizing tax-advantaged accounts for rebalancing. Transaction costs. Evaluate the costs associated with rebalancing, such as brokerage fees or bid-ask spreads. Minimize costs by using low-cost investment options, utilizing commission-free trades, or focusing on asset allocation adjustments rather than frequent trading. Document the process. Maintain records of your rebalancing activities, including the rationale for adjustments, transactions made, and any tax considerations. This documentation can help track the effectiveness of your rebalancing strategy and inform future decisions. Remember, rebalancing is not a guarantee of better performance or risk reduction. It is a risk management technique that aims to maintain the desired asset allocation. It's important to regularly review your investment strategy, assess your risk tolerance, and consult with financial professionals or investment advisors to ensure your portfolio remains aligned with your goals and evolving market conditions. Lastly, keep in mind that rebalancing should be part of a disciplined, long-term investment strategy. It's advisable to seek personalized advice based on your individual circumstances and investment objectives before making any rebalancing decisions. Exit strategies. Understanding redemption procedures and exit loads. Exit strategies refer to the methods and considerations involved in selling or redeeming your investments from mutual funds. When planning your exit strategy, it's essential to understand the redemption procedures and any associated fees, such as exit loads. Here's a breakdown of these components. Redemption procedures. Redemption procedures outline the process of selling or redeeming your mutual fund investments. Here are the key steps to consider. A. Contact the fund company. To initiate a redemption, you typically need to contact the mutual fund company directly. This can be done through their website, customer service hotline, or other designated channels. They will guide you through the specific redemption process. B. Complete required forms. The fund company may require you to fill out a redemption form either in physical or electronic format. The form typically includes details such as your account information, investment units or amount to be redeemed, and the redemption method, example, partial or full redemption. C. Submit the redemption request. Submit the completed redemption form as per the instructions provided by the fund company. This may involve mailing physical documents or submitting the form electronically through their online portal or app. D. Redemption settlement. Once the redemption request is processed, the mutual fund company will liquidate the necessary units or holdings to fulfill your redemption. The proceeds from the redemption will be paid to you via your specified payout option, example, bank transfer, check. Exit loads. Exit loads are fees charged by some mutual funds when investors redeem their investments within a specified period. The purpose of exit loads is to discourage short-term trading or frequent buying and selling of mutual fund units. Here's what you need to know about exit loads. Definition: exit loads are a percentage-based fee charged on the redemption amount. The percentage and the duration during which the load applies vary depending on the fund. Exit loads are often higher for shorter holding periods. B. Load waivers. Some mutual funds may offer load waivers based on certain conditions, such as holding the investment for a specified period or meeting certain investment thresholds. It's important to review the fund's prospectus or offering documents to understand if any load waivers apply. C. Consideration in investment decision. When selecting a mutual fund, take into account the applicable exit loads and their impact on your investment strategy. If you anticipate needing to redeem your investment within a certain time frame, consider funds with lower or no exit loads. D. Duration of exit loads. Exit loads typically apply for a specific period after the investment is made, such as 1 year, 3 years, or longer. Be aware of the duration of the exit load and factor it into your investment horizon and liquidity needs. E. Impact on returns. Exit loads reduce the amount you receive upon redemption. Consider the impact of exit loads on your overall returns, especially if you anticipate redeeming your investment within the load period. F. Load-free options. Some mutual funds do not impose exit loads at all. If liquidity and flexibility in redemption are important to you, consider investing in load-free funds. It's important to carefully review the prospectus or offering documents of a mutual fund before investing to understand the specific redemption procedures and any associated exit loads. Being aware of the redemption process and potential fees helps you plan your exit strategy effectively and make informed decisions regarding the timing and cost of redeeming your investments. If you have any questions or concerns about redemption procedures, exit loads, or other aspects of mutual fund investing, consult with financial professionals or investment advisors who can provide personalized guidance based on your specific investment goals and circumstances. Long-term wealth creation with mutual funds. Mutual funds can be powerful tools for long-term wealth creation, providing individuals with opportunities to grow their investments over time. Here are key considerations for leveraging mutual funds for long-term wealth creation. Start early and stay invested. One of the most significant factors in long-term wealth creation is starting early. The power of compounding allows your investments to grow exponentially over time. By starting early, you give your investments more time to compound and benefit from the growth potential of the market. Additionally, staying invested for the long term allows you to ride out market fluctuations and benefit from the overall growth of the economy. Define your financial goals. Clearly define your financial goals, both short-term and long-term. Determine how much wealth you want to accumulate and the time horizon you have to achieve those goals. Your goals will guide your investment strategy and asset allocation decisions within mutual funds. Diversify your investments. Diversification is crucial for long-term wealth creation. By investing in a diversified portfolio of mutual funds, you spread your risk across different asset classes, sectors, and geographic regions. This helps mitigate the impact of volatility in specific investments and reduces the risk of losing a significant portion of your portfolio due to the underperformance of a single investment. Asset allocation. Develop a well-thought-out asset allocation strategy that aligns with your risk tolerance, investment goals, and time horizon. Asset allocation refers to the distribution of your investments across different asset classes, such as stocks, bonds, and cash. Your asset allocation should strike a balance between risk and potential returns, adjusting as you approach different life stages or financial milestones. Regular contributions. Consistently investing in mutual funds through regular contributions, such as systematic investment plans, SIPs, is an effective way to build wealth over the long term. Regular contributions enable you to take advantage of dollar-cost averaging, meaning you buy more units when prices are lower and fewer units when prices are higher. This approach helps smooth out the impact of market volatility and potentially enhance your returns. Reinvest dividends and capital gains. Consider reinvesting dividends and capital gains earned from your mutual funds. By opting for dividend reinvestment plans, DRIPs, or automatic reinvestment options, you can acquire additional units of the mutual fund, enabling your investments to compound over time. Monitor and review. Regularly monitor the performance of your mutual fund investments, assess their alignment with your financial goals, and review their progress against benchmarks. Conduct periodic portfolio reviews to ensure your asset allocation remains in line with your objectives and make adjustments as necessary. Seek professional advice. Consider consulting with financial professionals or investment advisors who can provide personalized guidance based on your specific circumstances. They can help you select appropriate mutual funds, develop an investment strategy, and navigate market conditions effectively. It's important to note that investing in mutual funds carries risks, including the potential loss of principal. Past performance is not indicative of future results. Conduct thorough research, read fund prospectuses, and assess the historical performance, expense ratios, and risk factors before investing in mutual funds. Long-term wealth creation requires discipline, patience, and a focus on your investment goals. By harnessing the power of compounding, diversification, and consistent investing in mutual funds, you can set the stage for building lasting wealth over time.